we're in about this area, I actually drew this orange line. Like, that orange line has been there almost a year now. And the 50% target, retracement, right, to basically 160 predicts this drop to 132 or whatever it is. This, the 50% predicts the 1382. Oh, sorry, that is this one. I dropped my 121 before. Alright, so yeah, the 50% predicts the 1382. Where it predicts here. And we drew this line pretty close to this. So that puts us, about July. So what is that, 8 months ago, 9 months ago? So when those things matter if you're doing swings, and you may want to do things like, be short, or let's say get short. And once you're short, take profit because things may bounce, and then get back in, take profit. Alright, let it bounce, do it again, take profit, and you keep that up until it stops working, right? So according to this, if you're a bear, what you're hoping for, because we don't know if it's going to do it, but that's what you're hoping for, that this sucker keeps going down, right? What you don't want to see is an inverse head and shoulders, okay? And then to add to the funniness, we talked about that happening at the end of the first quarter, based on an improvement in GDP. And we did talk about that, a year or so. We didn't know anything about Brexit, though. Right, that wasn't in any of that analysis, because there was no such thing as Brexit at the time. Okay? So maybe that's why it's muddled up, but I'll tell you what, though, back in here, and this is when we did it, and I know you guys can confirm it, sort of back in this area, okay, we were doing things like looking at projecting future data that is used to calculate GDP in the UK. And there was a horrible winter at this time. It was freezing cold in the United States and in Europe. And the year before it was freezing cold and terrible in the United States and Europe in that sort of Christmas time. I remember my first 8 weeks of classes at Harvard. Every Monday there was a new snowstorm and they had to reschedule classes and stuff and wreak havoc on campus. And so we were talking about GDP, sorry, not Great British, GDP for the UK, and we just talked about things like how is it calculated, what is Carney saying, what are the things, why does Carney say don't worry about it when the data's so bad, and so on and so forth, and then what will improve, and we talked about, if we get normal weather, which you would have to assume at some point you'll get normal weather, it'll happen in January. Okay? Which means, when does this data get recorded, guys? A normal January. When does that get recorded? The second quarter. And we'll look back, and this GDP will be better than just this GDP. Especially if oil starts going up and not down, or at least sideways and not down. Because if oil in this period, let's say, was down 25%, that gets calculated in all the different things in GDP, right? Because you're spending less, so it's going to be recorded as less spending. And all of a sudden, let's say the decline in oil at this point is 0 versus minus 25%. So that's going to look good, because that's a huge improvement. But what if we hit $25 and it jumps to $50 or $40, right? So what if in the third quarter this gets recorded now as not as a negative 25, not as 0, but what if it's up 25%? What does that do to GDP? If you're looking at each of these little components of GDP, right? Consumer spending, government spending, business spending, exports minus imports, all that kind of stuff. All of a sudden you go from recording negative 25 to plus 25, because remember, to get a plus 25 is easy if the prices are low. Right? We're only talking about a $6 to $10 increase in oil prices, and you have a huge percentage. So all of a sudden, like, GDP is going to be way up. But the funny thing, guys, is we have logical, intelligent conversations about what would happen in, at the end of the first quarter is when we'd start tiptoeing in it, was the idea. And certainly we're going to start seeing I think I called them green shoots. Okay, we talked about it here, more than a year ago.